And right about 5 o'clock Eastern, when you see the market closing down, this would be at 5 p.m. Whoa. At 5 p.m. you would look to go short. That would be an aggressive trader. Now remember, you've got to have your stops placed correctly. You would have to have your stop placed above the high here. And conceivably you would have been just barely stopped out since the market did go back above that high. You also need to remember that the aggressive trader, you're going to take more trades than the conservative trader. The conservative trader is going to wait for whatever the market's going to do and then finally start moving, whether it's going to be down or whether the market starts moving like this and then the market goes up. In either case, the conservative trader waits for the market to get underway. So on a conservative end, what are we looking for? Well, we're going to look for something similar to this. We want to see that the market starts trading in some form of range like this. Once it starts trading in a range, now we have an area that we look for the breakout. Okay, we have the hand pattern up here. We have a hand pattern right there. So we would look at those two areas for the market to make its move. Then, if, for example, the market started going down, breaks through that low, we would wait then for the market to make its retracement, back up, boom. We have another point at which we can add to the position if it starts going down. To the upside, it would simply be the opposite. If the market's trading around like this, forming its range here, remember we want to wait for at least 4 bars. We've got 1, 2, 3, 4. Then we start looking for the hand patterns to form. So at this point, we have a hand pattern possibly here. Now we do. And we have a hand pattern here. So to the upside, with the market breaks to the upside, there's your entry. And we're simply waiting for the market to relax. There's our next hand pattern. We wait for the market to trade above. Okay? The key here, and I'm going to beat this like a dead horse, is you've got to just settle down and wait. Okay? Wait. Wait for the market to show you what it's going to do. We're expecting a big move here. We're not trying to get in on every little wiggle. You know, we're not seeing, or we're not trying to see something like this where we're trying to trade here. We're not trying to trade all this junk. Okay, we want to trade once the market breaks above there. Boom. Okay, the market comes back down. Maybe we get stopped out. Who cares? Now we trade above there. See, the market now makes its move. Let me get in here and we'll measure it out so you can see. Okay. Now actually, if you'd have taken a stop all the way back down here, it wouldn't have gotten hit. Okay, you would have, granted, you would have had to take some heat, meaning the drawdown, but it wouldn't have even gotten hit. But let's say that it did. You're still at a point where the market has moved you into profit. Now granted, it's a small profit, but even at this extreme, and believe me, I'm showing you this to demonstrate the extreme scenario here. Even if you were taking this huge stop of 327 pips, you can see here that the resulting move up would have put you back into a profitable scenario. Okay? You have to realize that.